Let me ask you something. If I gave you the best trading strategy in the world, would you suddenly become profitable? Or would you still find a way to sabotage it? Here's the uncomfortable truth. Most traders are not losing because of strategy. They are losing because of trading psychology, because of habits, because of emotional impulses, because of decisions made in seconds that destroy weeks of discipline. If you've ever chased a breakout and bought the top, doubled your position after a loss, moved your stop loss out of fear, or revenge traded after getting stopped out, this video is for you. Today, I'll break down the top 7 psychology mistakes losing traders make and exactly how to fix them. Let's begin. Mistake number 1, FOMO trading. Fear of missing out. This is one of the most destructive trading psychology patterns. Price is moving fast, the candles are green, Twitter is screaming bull run. You feel late, so you enter. No structure, no confirmation, no risk plan, just emotion. And what happens? The market pulls back. You panic. You exit at a loss. Professional traders don't chase movement. They trade structure. Here's the correction rule. If you missed the entry, you missed it. Wait for pullback. Wait for confirmation. Wait for alignment with your system. No setup, no trade. Mistake number 2, revenge trading. You take a loss. It hurts. Your ego feels attacked. So instead of stepping back, you step in harder. You increase position size. You enter impulsively. You try to win it back. This is no longer trading. This is emotional gambling. Revenge trading is responsible for massive account drawdowns. Professional mindset shift: losses are business expenses, not personal attacks. Correction framework: after any loss above 1R, you must step away for 15 to 30 minutes. No new trades, no exceptions. Emotion cools, clarity returns. Discipline wins. Mistake number 3, overtrading. Beginner traders believe more trades equals more money. Wrong. More trades usually equals more mistakes. Overtrading comes from boredom, impatience, and addiction to action. The market does not pay you for activity, it pays you for precision. Professionals wait, sometimes all day, sometimes all week. Correction rule: set a maximum daily trade limit. For example, 2 high-quality setups per day. After that, you stop, even if you feel tempted. Mistake number 4, no trading plan. This is the silent killer. Many traders enter trades with no defined entry criteria, stop-loss logic, position size calculation, or exit structure. They rely on feel. That is not trading psychology discipline. That is chaos. Professionals think in scenarios. Before entering, they ask, where am I wrong? Where is my stop? What is my risk to reward ratio? Correction framework: before every trade, answer 3 questions. What confirms this setup? Where is invalidation? Is this at least 1 to 2 risk to reward? If you cannot answer clearly, you do not enter. Mistake number 5, moving stop losses. This one destroys small accounts. Price approaches your stop. You think it will bounce, so you move it lower, then lower again. Now your small loss becomes a large loss. This is emotional trading at its peak. Professionals accept predefined risk. They do not negotiate with the market. Correction rule: your stop loss is placed at logical invalidation, not at emotional comfort. Once placed, it does not move, unless you are trailing in profit. Mistake number 6, confirmation bias. You want the trade to work, so you only look for information that supports your idea. Bullish article? You read it. Bearish data? You ignore it. This bias blinds traders. Professional traders ask, how can I be wrong? They actively search for invalidation. Correction habit: before entering a trade, write down 1 reason it could fail. If you cannot find one, you are emotionally attached. That's dangerous. Mistake number 7, inconsistency. This is the real reason most traders lose money long-term. They jump from strategy to strategy, from indicator to indicator, from YouTube video to YouTube video. They never give one system time to prove itself. Professional traders focus on process consistency, not outcome obsession. Correction framework: commit to one strategy, minimum 30 trades. Journal every trade. Track entry reason, exit reason, emotional state, and outcome. Review weekly. Patterns reveal themselves. Growth becomes measurable. The psychological reset system. If you truly want to break the losing cycle, you need structure. Here is your reset protocol. Step 1. Risk rule. Never risk more than 1 to 2% per trade. Capital protection first. Step 2. Pre-trade checklist. Before entering, is this a valid setup? Is risk defined? Is reward acceptable? Am I emotionally neutral? Step 3. Post-loss cooldown. After 2 consecutive losses, stop trading for the day. No exceptions. Step 4. Weekly review. Every weekend, review your journal. Not to blame yourself, but to improve your trading psychology. The identity shift. Here's the truth. Winning traders are not smarter. They are more disciplined. They feel fear. They feel doubt. They feel frustration. But they follow structure anyway. If you fix your trading psychology, your strategy will finally work the way it's supposed to. The market is not against you. Your impulses are. Control them, and you change everything. If this helped you recognize your own trading mistakes, start applying one correction rule immediately. Not tomorrow, today. And if you're serious about mastering trading psychology, watch the full playlist, Psychology of Losing Traders. Fix these mental mistakes fast. Because consistency is not built in one video. It's built through structured learning. This is Online Trading Hub, helping beginner and struggling traders build discipline, clarity, and confidence, so you stop trading emotionally and start trading professionally. I'll see you in the next lesson.